As my regular viewers know, my favorite type of stock to buy is a high quality, high yield stock. And the reason for this is very simple. I am a value investor, and so my main goal is to correctly value stocks and buy and sell them accordingly in order to take advantage of Mr. Market's irrationality, Mr. Market's moodiness, his tendency to overreact and underreact to various changes in underlying fundamentals of businesses, as well as macro factors that affect those businesses. And so as a result, the more I can reduce the uncertainty surrounding the valuation model, the more accurate my valuation will be. And high yield stocks in general are easiest to value because they generally have much lower growth rates, but they pay higher dividends. And so the return component is much more concentrated in the yield than in the capital appreciation component of the stock. And since it's much easier for a business, especially if it's a defensive, stable business model like a triple net lease REIT, a regulated utility, an infrastructure company with long duration contracted assets, it's much easier to project the future performance of those almost bond-like business models as opposed to some high-flying, high-tech stock like NVIDIA or Palantir, which you're really having to conjecture about future growth trends, future industry trends, potential competition, potential regulation, potential disruption. It's much harder to come to an estimate of fair value. Meanwhile, the high quality component, both in terms of the quality of underlying assets and the management, as well as the strength of the balance sheet, further reduces uncertainty because it makes it even more likely that the company is not only going to have sustainable cash flows from its assets, but that it's going to be able to continue paying that dividend. A recent example we just saw recently was NextEra Energy Partners, as I highlighted in a previous video, warning against a potential cut. Sure enough, it came. They completely eliminated the distribution, and that's because management did not manage the balance sheet correctly and had to eliminate the distribution, really, so that it could pay off its obligations, even though the underlying cash flows have remained stable. The business model itself is doing just fine. And so that's where the high quality component is so important as well. That said, just because a business has a above average dividend yield or even a really high yield, and it has a solid management team and a solid underlying balance sheet, it does not mean that it's a good investment all times. That's where the valuation component comes into play. And so in today's video, I'm going to discuss two stocks right now that I think are high quality and high yielding, but I don't think are good buys. They're overrated by Mr. Market currently. And then I'll also discuss two that are high quality and high yield, but I think are being underrated by Mr. Market and therefore are good buys right now. Before I get into the rest of this video, though, if you want to get regular weekly dividend content, both in terms of my top picks, stocks that I'm warning against, like the NextEra Energy Partners cut, I was warning about that months ago, back when the stock was about 3 times higher than it is today. Or if you want to learn about some of the best dividend ETFs out there, CEFs, my investing philosophy and strategy, and more to come in the coming months and years, please subscribe to my channel. You'll get at least 2 videos a week, sometimes more. Of course, if I'm sick or something, maybe less, but generally be 2 or more videos per week. Thanks so much. I really appreciate your viewership. Okay, so what are the two overrated? Well, the first one is ONEOK, ONEOK. It's ticker symbol OKE, and it's a midstream infrastructure company. It's had a great recent run. Stock has run up really aggressively. It's a solid dividend payer, has an investment-grade balance sheet, well-diversified business model. It recently acquired Magellan Midstream Partners, which is one of the elite MLPs out there in terms of yield and distribution growth track record. And so OKE is a great business. It's more than just okay. I would say it's a very good business. And it still has a decent dividend yield that's about 3 times what you'll get from the S&P 500, as it's a little under 4%. It's 3.5% to 4%, depending on the day. So a very solid dividend. It's well covered by cash flows. They expect to grow at a mid-single digits pace moving forward. But therein lies the rub. With a midstream business model, there's only so much growth you're going to generate on a cash flow basis. It's not a high-flying, high-growth company like a NVIDIA or Palantir or what some of the big Magnificent Seven were back in the day. It's just not that kind of company. And even the most favorable macro environments, which we are in a very favorable macro environment for their business, the growth may bump up a little bit incrementally. The growth runway may expand, but there's not going to be a rapid acceleration. So you're really stuck with a mid-single digits annualized growth rate on average over the next several years with OKE. And with the yield being 3.5, maybe a little bit higher, you're just going to get a high single digits annualized total return, assuming no valuation multiple changes. And with interest rates appearing likely to remain higher for longer, and the fact that many of OKE's peers, even on the 1099, the non-K1 peers, and certainly the K1 peers are meaningfully higher yields like Enterprise Products Partners, MPLX, Energy Transfer, Plains All American. Those all have much higher yields. But even in the 1099 space, the C Corp space, you have companies like TC Energy and Enbridge that have yields well above 5%, even close to 6% in the case of Enbridge. And so I just don't see much valuation multiple expansion for OKE moving forward. In fact, I could see a case for contraction. And as a result, I just don't see how investors are going to get any more than a mid to high single digit annualized total return here for the foreseeable future. And so for that reason, I think OKE is overrated, and I would steer clear of it in favor of other midstream options. Of course, if you have a big gain in it and you don't want, in a taxable account, okay, there's a case to be made to just hold it and not have to pay capital gains depending on your personal tax circumstances, but that's a separate matter. Just in terms of looking at it fresh today, I'd say at best it's a hold. You can make a case for a sell there. So I would say OKE is overrated. Steer clear. The other overrated stock I'm going to talk about is ARCC Capital Corporation. Now, this is a business development company. It has an incredible track record, one of the best in the sector, behind only the likes of like Main Street Capital and a handful of others. And ARCC is especially impressive because it's externally managed as opposed to internally managed like Main Street Capital. Therefore, hasn't enjoyed the same premiums to NAV historically that a couple like MAIN has, so it hasn't been able to issue shares accretively to fuel that growth and that virtuous cycle. Still, ARCC has been very prudent when it's traded at a premium to NAV. Management has taken advantage of that and issued shares accretively. When it's traded at a discount to NAV, management has done a good job of not issuing shares. In fact, I think has even repurchased some shares on occasion. They've also been very consistent with maintaining their dividend and growing it strategically over time when they've been able to, but on a very conservative basis. They have a lot of spillback income that gives them an additional cushion for their dividend. They have a solid investment-grade balance sheet. They've got very good underwriting performance, and they've been able to do that despite having a more offensively positioned portfolio. So they generate higher returns off their investments, but they've still been able to avoid much in the way of non-accruals and NAV declines. So they've done a really good job with that. They've paid special dividends opportunistically. But right now, I think, again, this is a case of a high yielding. It's got an 8% yield, high quality, like I've said, business. But I think it's overrated by Mr. Market, and here's why. First of all, they trade at a very, very high valuation. Their price to NAV ratio is getting close to 20% premium, where historically they've only traded in line with NAV. And I think you can make a case for a premium to NAV just because of the strong track record, but I don't think they deserve much of a premium to NAV, and here's why. Yes, some of their peers trade at big premiums to NAV, but ARCC actually has one of the highest expense ratios of any publicly traded BDC. That means that their external manager, ARIS Management, they are charging you, the shareholder of ARCC, a very hefty fee in order to manage the BDC. Yes, they do a good job, and so they do deserve that fee, you could say. And as a result, I don't think they should trade at a discount to NAV. But I don't think they deserve a 20% or even 15% premium to NAV, especially because right now, the Fed is in a cutting cycle. Yes, the pace of cuts is likely to slow. Some would argue they should even cut any more because inflation is remaining persistent. The economy still seems pretty strong. But I think it's very unlikely the Fed's going to hike rates, and it's pretty likely they're going to cut at least once this year. And so that's going to be a headwind for ARCC's net investment income because in recent years, with the Fed hiking rates but the economy remaining stable, ARCC's net investment income has soared, and that's fueled dividend increases, supplemental dividends, strong NAV, et cetera. And so that's been really good for the fund and generated its outperformance recently. But I think moving forward, the cycle is going to shift and it's going to be a bit of a headwind. I don't think a huge headwind. I'm not calling for a dividend cut or anything like that. But I don't think that, again, the ARCC quite deserves the premium that it has. And so between the 8% yield, I don't see really any much in the way of earnings growth moving forward unless they can really issue a lot of shares at a high premium, take advantage of the current premium and invest it really creatively. Perhaps that could generate some growth. But again, the yield is not terribly high right now, and I think they're going to have some headwinds from interest rate cuts. And so I think at best, ARCC is a hold right now. And so I just would steer clear. There are other BDCs that offer much better value. I've discussed them previously on this channel, but one, for example, is Golub Capital BDC, has a much lower expense ratio from its manager than ARCC, despite having a very prestigious manager, strong underwriting performance, has a over 11% dividend yield that's well covered by income. And so I actually think GBDC, for example, would be a buy, whereas ARCC, I would say, is a hold at best, steer clear. Okay, so what about some underrated dividend stocks right now? Well, two that I'm going to discuss here is one is a triple net lease REIT, WP Carey. I've discussed it before in this channel. And the gist here with WP Carey is basically that it has a 6.5% dividend yield, which is much higher than it's historically offered. It trades at a discount to its net asset value in the single digits. Not a big discount, but it's historically traded at a 10 to 15% premium to its net asset value because it has a high-quality management team, a really well-built portfolio of assets that would be impossible to replicate as an individual investor. And so you get that nice instant diversification, professional management, high-quality asset, real estate portfolio that has majority of its rental escalators coming in from CPI-linked rent escalators, which makes it more inflation-resistant than most triple net lease REITs. It has a BBB plus credit rating, which gives it an attractive cost of capital. And again, it's got attractive growth opportunities in both Europe and the United States, where it can tap into wherever the opportunities are better, wherever the debt is, costs are lower, to optimize the risk reward for shareholders. They've completed a big portfolio transformation, moving out of the asset management business, moving out of the office space. They've sold some of their hotels. They've sold off some of their other non-core assets. They have a publicly traded holding in a company that they could sell at any time to generate a significant liquidity that they can use then to fund their growth pipeline. So I think WPC is looking up between the price to NAV expansion, likely the attractive dividend yield, and likely mid-single digit AFFO per share and dividend per share growth moving forward. We're looking at a low to mid-teens annualized total return with quite low risk. So I think WPC makes for an attractive real estate investment right now. So I've already actually discussed two underrated stocks, both GBDC, I briefly discussed them, and then I've also discussed WPC. But the other underrated stock I wanted to point out today is simply Enterprise Products Partners. And now, obviously, I've mentioned them already too as an alternative to OKE. But I think that EPD is underrated right now because, yes, its distribution yield is lower than it's been in recent years, as it's now dropped down to about 6.5%. But it has a 3 times leverage ratio, the strongest credit rating in the midstream space, a well-diversified portfolio that management has made clear is positioned to benefit from its exposure to data centers. And on top of that, it's expected to grow at around a 5% CAGR, both in terms of its distribution per unit as well as its distributable cash flow per unit. So combining that with a yield of 6.5%, it's a very similar thesis to WP Carey. You have that 6.5% yield, a strong defensive, high-quality business model, strong balance sheet, roughly 5% annualized growth rate, and that sets the stage for likely valuation multiple expansion as well for APD because its EV to EBITDA is only a little bit over 10 times compared to its history of about 12 times, and most of its peers trade in that area. I think you can see a strong case for valuation multiple expansion. So I expect both EPD and WPC to deliver very similar total returns moving forward. Of course, the case for WPC is a little bit stronger than EPD in terms of valuation multiple expansion just because it has that price to NAV, which is a current up-to-date relative to the underlying marketplace, as well as the fact that WPC trades well below a much larger discount to where it has historically than EPD has, because historically real estate has commanded a greater premium to midstream assets just because they're considered to be more durable. That's changing some in the age of AI, but still I think that even WPC even has more upside potential than the EPD, but I still think EPD is underrated as well. So hopefully this video added some value to you. If it did, again, please subscribe to the channel to get more content like this. Give the video a like. Let me know in the comment section below what you think of these picks, as well as the ones saying are overrated. Let me know what other ones you want to talk about. Thank you so much. See you next time.